Friday afternoon, 4:47 p.m., I just approved 640 paychecks through our corporate banking portal. $1.66 million, gone in a single click, the exact same batch I have run every 2 weeks for 9 years without once asking what happens to it in between. For the first time in 9 years of managing corporate payroll, I did not close my laptop and walk out the door. Something about that confirmation screen stopped me. I hit start on a stopwatch instead. 3 critical questions need to be answered before this stopwatch crosses the 3-minute mark. First, where does that money actually go in the exact window between leaving our company bank account and arriving in yours? Second, how much does it earn this very week in real numbers while sitting inside the banking pipeline? And third, what did I discover about the bank account of Priya, my colleague 2 floors up, while looking through records I was never supposed to connect? 0.01%. That is what the bank pays Priya on her $10,000 in savings, $1 single per year. The exact same bank earns 3.8% overnight on money that does not even belong to them yet. I am going to show you exactly where that massive spread goes and the open doorway nobody ever showed you how to walk through. A quick note. I'm John, I run payroll at Bennett, and this channel is the paperwork nobody explains to you at work. Every week I pull back the curtain on one document most people sign without reading. The fine print on a 401k form, the clause buried in a pay stub, the interest rate printed on the back of a bank statement. If this breakdown gives you clarity, hit the like button and subscribe right now, because what I found in Priya's account is the clearest example yet. Now, let's look at that account. Here is what I found before my stopwatch hit 90 seconds. When Bennett's payroll leaves our main corporate account, it does not magically teleport into 640 individual employee accounts. It enters the ACH network, the automated clearinghouse, the exact automated system that processes virtually every payroll check, mortgage payment, and direct deposit in America. Every batch gets bundled, transmitted to the Federal Reserve or a private clearinghouse, sorted by destination bank, and released on a settlement schedule that has barely changed in decades. Same-day ACH exists now, but most payroll runs, hours included, still go through standard next-day processing because same-day options carry extra fees most payroll departments never bother enabling. And in that gap between sent and received, usually 1 full business day, sometimes 2 over a weekend, that money sits. It is not lost, it is not frozen, it is simply parked, waiting in an intermediary account controlled by the banks that move it. This is called the float, and every bank in the country runs it the same way. Banks never let money sit parked for free. Overnight they lend it, to each other, to the Federal Reserve, or into short-term treasury markets, earning interest on every single passing hour. This isn't a financial conspiracy. It is simply the plumbing of the financial system that nobody takes the time to explain to you. The same core mechanism that has existed since paper checks were physically flown across the country on overnight mail planes, back when the float sometimes stretched to 3 or 4 days instead of 1. Verified right now, that overnight lending market pays close to 3.8% annualized. That is not a theoretical projection. That is not last year's number. That is what it pays right now, this week. Most of that yield flows up to a correspondent bank or sits in a Federal Reserve account, generating return before it ever reaches Priya's balance. Bennett's bi-weekly run, $1.66 million, sits in that window for a day, sometimes 2. At 3.8%, even 1 day represents serious money, roughly $173 in overnight interest on a single payroll run for a single mid-size company. Multiply that across every payroll, every corporation, every business day nationwide. Thousands of ACH batches settling every single hour of the business day, moving trillions of dollars a year through the exact same intermediary accounts. And it is a continuous financial engine running quietly behind the entire economy. It does not show up on any pay stub, any tax form, or any employment agreement you signed. Nobody explains it because nobody is required to. It runs silently 26 times a year for our company alone and roughly 250 business days a year for every company that runs payroll through the same pipeline. Think about the chain for a second. Our bank holds the float overnight, lends it into the federal funds market or parks it at the Fed, collects close to 3.8% and passes almost none of that yield down to the account it eventually lands in. Meanwhile, the account that money eventually lands in, the national average savings account, pays 0.38%, not 3.8, 0.38, 10 times less than what that exact same dollar earned the day before for someone else. That is not my estimate. That is the official FDIC national average across all insured banks in the country. The spread between what the pipeline earns and what the destination account pays isn't a glitch in the system. It is the system running exactly as designed for the party that built it. And the wildest part is that nothing about this is hidden or illegal. It is disclosed, it is regulated, it is completely legal. It is simply never explained because explaining it would mean fewer deposits sitting at 0.01%. Look at Priya's $10,000. At the same bank whose overnight float earns 3.8%, her personal yield is 0.01%, 1 cent per $100 every year. That is the default rate printed in fine text on the flyer she signed when opening her account, which she never looked at again. 9 years running payroll, and I had never put those two numbers side by side until this Friday. That is not Priya's fault. Nobody ever showed her that options existed, and to be completely honest with you, nobody had ever shown me either. But here is what I promised you. That 3.8% market is not locked inside an institutional trading desk. It is not restricted to high net worth investors. It is not a trick. It is the U.S. Treasury bill market. And anyone with a standard brokerage account or a free account at treasurydirect.gov can buy the exact same short-term government debt the bank uses. Setting up a Treasury Direct account takes about 10 minutes. Your social security number, a linked bank account, and no minimum deposit to open it. You can also buy the same T-bills through most standard brokerage accounts, which is often faster if you already have one open for other investing. Zero minimums, zero commission fees, zero middleman required. That door has been standing wide open for decades, silently, all this time, and almost nobody walks through it because almost nobody knows it exists. When I showed Priya the actual numbers side by side, her first question wasn't, "Is this risky?" It was, "Why did nobody at the bank ever mention this?" And that is exactly the question this video is built around. Let's look at what that same $10,000 earns across options. In Priya's bank account, $1 a year. At the national average savings rate, $38. In a 3-month Treasury bill, near 3.8%, roughly $379. Same person, same 10 minutes of effort, $379 of net difference every single year, purely based on which box was checked at the start. Scale that up on $50,000 of idle cash, not unusual for someone mid-career with an emergency fund and some savings parked between jobs. That same gap becomes almost $1,900 a year every year for doing nothing except moving money from one account to another. Let's be completely transparent about the trade-off. A Treasury bill is not a standard bank deposit. It is a government-backed obligation, as secure as cash, but your money is committed until maturity unless you sell it early on the secondary market, which can take a day or two to settle and may involve a small price adjustment depending on where rates have moved. You can buy them starting at just $100 on Treasury Direct, which surprised me when I first checked because I incorrectly assumed it required massive capital. Interest on Treasury bills is also exempt from state and local income tax, which matters more the longer you hold them and the higher your state tax bracket happens to be. Here is the realistic 5-option menu for putting idle cash to work, from simplest to most structured. 1. High-yield savings accounts. Top competitive online banks pay up to 4.15% right now, FDIC insured, with instant liquidity. The trade-off: the rate is variable. It shifts when the Federal Reserve changes rates and can drop without notice. 2. Short-term Treasury bills. Near 3.8%, backed by the federal government and exempt from state and local income taxes. The trade-off: capital is locked for the term, 4, 8, or 13 weeks, though you can always sell early on the secondary market if you need the cash. 3. Series 1 savings bonds, currently 4.26%, adjusted for inflation twice a year. The trade-off: capped at $10,000 per person per year, locked for 12 months, with a 3-month interest penalty if redeemed before 5 years. 4. 1-year certificates of deposit. National averages sit around 2.49%, though online institutions offer better. The trade-off: early withdrawal penalties apply if you need cash sooner, and the rate is locked in either direction, good if rates fall, bad if they climb. 5. Money market funds through a brokerage account. These track short-term rates closely and can be a natural landing spot for cash you're not ready to lock into a treasury term. The trade-off: they carry SIPC protection rather than direct FDIC deposit insurance, though historical stability is extremely strong. None of these 5 requires specialized knowledge or a financial advisor to open. Every one of them is available directly to an individual account holder today in under 15 minutes, and most people who try this end up splitting their idle cash across 2 or 3 of these rather than picking just one. An important clarification: I am not a financial advisor, and this is not personalized financial advice. This is an objective breakdown of current market rates and their trade-offs. If you're looking for the simplest starting point, high-yield savings is usually the easiest entry because of immediate liquidity. Here is what Priya actually decided to do. First, a high-yield savings account for her emergency buffer. Second, a short-term treasury bill ladder for cash she won't touch immediately. Third, most importantly, she actually checked her current rate. On the portion shifted into treasuries, she unlocked roughly $379 a year in additional income. The stopwatch I started at 4:47 p.m. is still ticking. Somewhere right now, another company's payroll float is sitting in transit earning interest for someone else. The only difference is, now you know exactly where the door is. In the next video, I sat down with Frank, who spent 40 years managing institutional money through 3 major market crashes. Today, 79% of institutional investors are bracing for a pullback. He broke down what actually matters when markets shift. Not predictions, but preparation. That single conversation changed how I view my own portfolio. See you in 2 days.